Always good to catch up with you. I mean, you've been sort of preaching that there's value outside the big NASDAQ names. Where does that leave you right now, considering you'd probably need a pretty good economy for a lot of those stocks to work?
How bad can the economy be if consumers are paying $100 for dog perfume?
Fair enough.
I think it's fair to say that you do need a good economy for the banks to do well, for the auto-related companies to do well. But I don't think it needs to be anything incredible. And the levels we're at today just don't seem that far above trend. We're looking at companies like General Motors that going into this correction was selling at about 5 times earnings. And it's gone down enough that it's only 4 times earnings now. Or Citigroup that was at about 6 times expected 26 earnings. Now it's at about 5 times. And people say, well, when will investors ever get interested in these stocks? But the companies are taking matters into their own hands and aggressively repurchasing shares. We think that'll drive prices higher toward fair value.
So that's the answer to, I guess, the question of, are these not just chronic value traps that really require investors to look over the possibility of a potential, downturn in the economy, right? I mean, how long has GM been trading at a single-digit multiple?
For too long, and we've owned it for too long with it trading at a single-digit multiple. But what's changed is this year they have rededicated almost all of their excess cash flow to share repurchase because they believe the stock is just too cheap. It makes it difficult for them to invest in anything else because nothing else has such good returns. And I think investors have never paid as much for growth that comes from shrinking the denominator, share repurchase, as they do for top-line growth. So even though these companies are relatively mundane at the top line, their earnings per share growth matches some of the best growers in the market.
And I guess I'd love for you to weigh in on Alphabet, which has, of course, been a big holding, has come under some turbulence here with the regulatory concerns. What's the way to think about this business right now?
Well, the way we've always thought about Alphabet is if you kind of separate out what they're doing in their venture capital spending, other bets, and add that back to income, you're not even paying a full market multiple for search. And investors have gotten concerned given the court ruling that could put into question whether or not Google can be the default search on iPhones. We saw the same thing happen in Europe about a year ago. Investors are presented with an array of choices of what search engine they want to take. And we've seen no decline in Google's market share since then. So we think investors are overreacting, and we don't think it would be a big deal if they couldn't be the default search.
Bill, let's also get to Charles Schwab. I don't remember having discussed that name with you in the past. It's one of your larger holdings in the Oakmark Fund. Why?
We like Schwab because of the cost advantage they have over the other large asset gatherers. They are maybe 2/3 the cost of the larger platforms like Fidelity and Vanguard. The old wirehouse firms, they're significantly cheaper. And because of that, they've been able to grow assets significantly faster than the rest of the industry. Schwab's method for doing that has been to give away a lot of services for free and then kind of make it up on the interest income on cash balances. There's been concern that maybe they won't be allowed to do that going forward. Yes. We think that's probably overblown. But if we're wrong, we think Schwab could start charging fees or could kind of revert away from the bank model, and it would help to expose to investors how profitable this company really can be. And it's growing significantly faster than the industry, selling below a market multiple.
Bill, curious what your thoughts are on the industrials. The sector is trading right around a 5-month low, and the name that you're a buyer of, Deere, has significantly underperformed the market on concerns about weakness in the ag economy. What are investors missing?
Well, we used to own a lot of industrials. Our thought was they were selling at about 2/3 the market multiple, and we thought they deserved to sell at a price as high as the average company. That did happen on most of the industrials, and because of that, we sold most of our positions. But Deere is a relatively new holding for us. It sells at about 2/3 the market multiple, very dominant in market share in the ag economy. And I guess the thing that's different about Oakmark is we're trying to make an estimate of where these companies will be 5 to 7 years from now, not what's going to happen in the next quarter or two. And when you look out that far, we think Deere is going to maintain very high market share. It'll be able to increase price for its products because they continue to make them more productive for farmers. And they kind of split the difference, that the farmers benefit from that productivity increase as do Deere shareholders. So we think Deere deserves to sell at a market multiple.